That takes us to our talk of the tape. So is this just a midsummer squall to wash away some excesses, refresh the bull market, or is a more threatening change in the market weather underway? Here to weigh the evidence are Joe Terranova of Virtus Investment Partners, a CNBC contributor, as well as BMO strategist Brian Belsky and Alicia Levine, BNY Wealth Head of Investment Strategy. Welcome to you all. And Joe, you know, extended periods of calm markets, often followed by a little bit of action, a little bit of turbulence. We have that here. What's the message you read in what we've been dealing with?
Well, listen, you've done a great job all year talking about how Q3 could be a little bit bumpy. And it seems as though as we move into the earnings season, that's exactly what we're going to be getting right now. For the viewers, for investors out there, long-term investors, this is a tough environment right now because you have so many conflicting signals on a daily basis. It looks like we're getting this rotation within the market. Early this morning, it appeared as though that would continue. NASDAQ came under pressure. We had small caps lifting, but we've reversed that now intraday. And now for the first time, really in the last couple of weeks, you have a universal sell-off, a broad-based sell-off. You have small caps down. You have the NASDAQ down. You have the momentum factor down. A lot of the leaders that I've talked about on halftime, I own some of them. Goldman Sachs, JP Morgan, they're down significantly. Eli Lilly down as well. So
yeah, Chipotle's down like 5%
I think
again.
The picture that tells it all, if we could pull it up, is the VIX. Because you've got the VIX spiking up to 16. I know that doesn't sound high, but it's certainly a lot higher than it's been over the last 3 months. It's its highest level since April. We were above 21 in April, and we probably have the blossoming of a much-needed correction.
You know, Alicia, it's maybe just a little bit of a reminder to investors that a broader market, or one that's not kind of anchored by a handful of huge stocks, is not necessarily in the near term a more stable one or a more predictable one. But how do you think investors should be reacting to it, if at all?
So I see this as the healthy correction in a broader uptrend. I mean, as you said, we're coming into seasonal weakness. August and September sort of never failed to disappoint on the index level, and we're heading right into it after an epic climb the first half of the year. So that makes sense to us. What looked like rotation into small caps, it can continue, but ultimately, I think if you go forward structurally, the large caps are going to take over here simply because there's not enough market cap in the small caps to absorb the total rotation out of the large caps. If you just look at the top 10 stocks of the S&P, they're 5.5 times the market cap of the Russell, and the S&P itself is 15 times the market cap of the Russell. So it's a little bit like putting an elephant through a needle, which is what we saw. We saw 3 and 4% moves in a short period of time. That has to be digested. It's very healthy. An average year has a 12% drawdown on the index level for the S&P. We barely had 6% in April, and I think we're probably due for another 5% here.
You know, Brian, the big versus small equation and that bit of rotation, or at least just a little bit of a comeback from those extreme relative performance metrics, is only one way of viewing what's going on, right? It's also kind of a growth into value. It's the very top of the S&P into some of the rest, things like financials doing better here. So how do you read that, and what should we extrapolate, if anything, from the relative moves in the last week or so?
Well, thanks for having us, Mike. We would say that what's happening is very normal. We would say that this is part of a very broad and big picture normalization process, believe it or not. What's happening in the market, we said 8 months ago in print that the average correction during the second year of a bull market, which we've been talking about now for 2 years, within a 25-year secular bull market, which we've been talking about since 2009, is 9.4%. As Alicia said, we only had 5.5%. That's not enough. And obviously, on a near-term basis, we were overheated. Now, I do believe that it's very normal to get broader participation. We are entering a golden age of stock picking where you're going to need to own a lot of everything. Our theme for 2024 was everybody love everybody, meaning you got to own a little bit of everything, and now it's starting to come into fruition. So value was massively oversold on a technical basis, so a small mid-cap. But it's not about just technicals and price, Mike. This is about fundamentals. Now, starting with small mid-cap, we're talking about earnings discernment, cash flow, balance balance sheet strength, the strongest in my 35-year career. You have a scarcity proposal in small mid-cap, too, especially given the fact there's no banking deals and nobody's buying small mid-cap over the last few years. And then lastly, on value, more of a GARPy value we think makes more sense. But we do think everybody's going to go up together once we go through this very normal correction, and it's happening right now.